Why is it that listed property is lost in the region of about 5% today?
It's basically been driven by the bond market. We saw the bond market move from 8% to about 8.6%, largely driven by offshore selling and the market believing that we're at the bottom of the interest rate and inflation cycle. So property tends to track the bond market.
With that in mind then, how does listed property compare to other asset classes?
Well, year to date, it's actually been the worst performer. Equities have done relatively better.
Yeah.
But if you look at last year, we delivered 30% as the best performing asset class. But you invest in property for income, whereas equities are chasing capital gains.
We'll talk about that in a second. Talk to us about the correlation that you've referred to between the bond market and the listed property market. Exactly how does that correlation happen? Because we're told generally it's about an 83% correlation.
Well, it's the opportunity cost. So bonds give you income, that's your coupon. Property rental income, actually declare that as distributions. So you look at how does property actually compare with bonds. So when bonds weaken, property prices have to weaken as well to catch up with that market.
The fact that we may see bonds weaken further with regards to the sell-off that you've referred to, people looking for yield back in traditional markets, what are the prospects then? Well,
we could see capital losses. Actually looking at bond yields moving up to about 9%. And if that happens, you're looking at about 8% total returns from the property market. But you still get your income, which is about 8.9%, driven by 6% income growth.
In this market, okay, you've just told us about the income growth. Just give us an outlook in terms of what we could expect in 2011 by way of income growth and returns, because when things were really well, we were seeing returns in the region of 30%.
Sure. Well, actually, when you're investing in property, you're looking at income. So we talked about 6% growth. That we believe is going to be ahead of inflation. And that 6% when it grows, it gives you a forward yield of about 8.9%. Compare that to the 10-year bond currently, it's trading at 8.4%. If you're going to put your money in the bank account, you're getting 6.3% cash. So property's got a better income.
Impact of changing prices in the sector?
Well, actually, it's a big risk as well, with bonds actually looking to go up. But what you say to our clients is that you're there for the long term. And you have to ask yourself, what is your objective? If your objective is about chasing capital growth, then actually property is not for you.
Right.
Probably have to chase income, and you look at your horizon as well. Are you there for the short term? We look at about 3-year horizon in the property space, at least.
And then within this particular space, as to impact of changing prices, for those that are looking particularly at the retail sector within this component, what are the benefits for them?
Retail sector is about 50% of our sector. We've seen trading updates from retailers, all looking good. And we've looked at some of the shopping centers that we're invested in. Foot counts are increasing, spend per head is increasing, arrears are coming down, vacancies are coming down as well. So it's quite positive, and we love that sector at this stage.
Let's talk about this issue that I mentioned earlier on about whether or not property was still the best asset class to be investing in, because effectively it is a hybrid of equities and bonds within this one component. So just spreading your risk as an investor.
Yes, as a house view at Stanlib, we're neutral on property, overweight in equities and underweight bonds. So you need to have that asset class. It behaves differently from equities and bonds. So there's always a space for listed property in a balanced portfolio.
Okay, you focused a lot on bond yields and the fact that we may see bond yields moving up, and so that may have an impact directly on earnings. What about issues such as interest rates going forward? Because we're told that with inflationary pressures kicking in, we may see the South African Reserve Bank act, certainly in the last quarter of this year, and other issues around taxes. We await to hear the budget speech of the Minister soon.
If you look at interest rates, you look at the debt profile of listed property companies. Most of them have hedged their debt for about 3 years. So you have to watch out the companies with floating rate debt. They'll be exposed when rates rise. And talking about rates and taxes, it's quite a big concern for our sector. We've seen actually costs increase by double-digit numbers, about 20%, because of the city council pushing up the rates and taxes. So actually expense is actually growing faster than income. So you have to look at how actually companies are positioned with that.
All right, the investment horizon, you're saying if you're moving into property, take a long-term view?
Sure. Property, I'll give you an example that leases, tenants sign 3 to 10-year leases. So to get that benefit, you have to be there for the long term. And that income actually grows every year, and we believe that's going to be in line or better than inflation.